Why is the stock market important to everyone? Do you often wonder, is the stock market really important to me? I don't own any stock, bonds, or mutual funds. What do I have to worry about? Well, if you're not quite sure about that, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. You've probably heard of the stock market, but just what is the stock market? A stock market is a public market where people can buy and sell shares on a stock exchange. Think of it like going to the mall. But instead of going to the mall and just buying things, you go to a stock exchange not only to buy shares of a company, but you can also sell shares of a company. Unlike a mall where there's just buying, on a stock exchange there is both buying and selling. The shares of stock represent ownership of a company. So if you buy as little as one share, you are a part owner of that company. Now don't get too excited about things. There are different types of ownership. So just because you're a stockholder doesn't mean you can set all the rules and they have to do what you say. But you do have a voice, and you can vote for people that do make the decisions within a company. The value of the shares that you have fluctuates each day. Some days they may go up, other days they may go down, or they may stay the same. Why do stock markets even exist? Stock markets have existed for hundreds of years. You can read about some of the early stock exchanges from 300 or 400 years ago. There's been trading going on ever since people have been around. So the idea of being able to buy and sell goes way back. Stock markets provide companies with a source to raise capital for investment and expansion. What will often happen is a company will get together and decide, we want to grow, we want to hire new people, we want to have new products, we want to move into different countries. But we don't have the money to do that. Well, one alternative that they have is to sell off part of their company. People pay for those shares, and then that money can be used to do the projects that they decide to do. This helps to create personal wealth as well. A lot of people have made a lot of their wealth from the stock market. One of the most famous people is Warren Buffett. You've probably heard of him. He's a very famous investor, and there are other famous investors too who've been quite successful and have made a lot of money in the stock market. Stock markets also help increase investments in the economy. In a good, healthy economic environment, people will be buying stocks. They have their own personal expenses taken care of. They might have some extra money, and so they put that into the stock market. This is done during good economic times. When the economy is having very difficult times and people are just trying to get by, they may not invest during those times because they need to put food on the table or they need to pay their bills. So if you see a lot of investing going into the stock market, typically the economy is doing well. Stock markets also serve as an indicator of the state of the economy. Not only people participating in the stock market can be a good sign of a healthy economy. If the stock market is going up, generally, that makes the world a better place. Most people are long in the stock market, which means they hope to buy low and sell high. Well, as long as the stock market keeps going up, everybody seems to be happy, and everybody thinks that they're a genius and makes all the right decisions at the right time. When things turn and go down, that's where people can really run into problems. A lot of times you'll see a direct correlation between the economy and the stock market. The two tend to go hand in hand with each other. There are always exceptions. For example, after an initial shock, the stock market rebounded and has held together pretty well since the COVID-19 lockdowns. A lot of this is due to stimulus packages and monetary policy that's very favorable for investors. People are asking now, what's going to happen when all of those stimulus packages or the monetary policies that are in place don't work any longer? Or other negative signs such as inflation, hyperinflation, or even deflation start to occur. During difficult economic times, the stock market will often suffer as well. In fact, if you study history, the 1929 stock market crash is considered to be the start of the Great Depression. Now, a lot of people didn't have stock in the stock market, but it was a point in time that people can look at and say, that's when it all happened. Even though things were happening before that and other things happened that really didn't have as much to do with the stock market, we can point to that as an event that triggered the Great Depression. The stock market does not operate in a vacuum. It's not all by itself. There are geopolitical events, there are economic events, there are things going on in Washington, D.C., there are the forces of supply and demand, there are other markets that have an influence not only in the U.S. but around the world. The stock market is just one piece of the overall puzzle that helps to define an economy. The stock market doesn't trade on what's already happened. They trade on what they think will happen in the future. And if there's a positive outlook, the stock market will go up. If there's a negative outlook, the stock market will go down. Now, there are events that catch the markets by surprise, and the markets will react to those, but they're usually short-term in nature. Just for example, when the COVID-19 pandemic first started in the U.S., the market was at all-time highs. It just tanked, huge, over a very short period of time, but quickly rebounded, and since that time has been holding up quite well. So if you were to ask the stock market, what does it think of the future? It looks pretty positive, but there are also a lot of other forces at work in the stock market that are keeping the stock market high. Also, this produces confidence in the economy. If a country has a good, solid stock market, that is one sign of confidence, that people believe in that country, not only the people that live in that country, but other countries are willing to invest. In the U.S., not only do Americans invest in the stock market, but investors and institutions from all over the world invest in the U.S. stock market. And even if you don't directly invest in the stock market, it can still impact you. There are companies, when they're doing really well, they can expand, they can hire people, their stock prices are going up. That looks really good. What happens if their stock price starts to go down and the economy starts to contract? People get laid off. Or people don't get the raises that they wanted, or the benefits that they were expecting. So this can influence people that may not even participate in the stock market, although most people do participate in the stock market and don't even realize it. If you have a pension plan or an IRA or some kind of retirement plan, you are invested in the stock market. So why should I even care about the stock market? Doesn't really matter to me. I don't go in there buying and selling like all the big fat cats do. I'm just living my life trying to get by day after day. It really doesn't matter. Well, think about that again. Everyone is affected by the stock market, regardless of whether or not they invest in stocks. As I mentioned a minute ago, when companies are growing, they hire more people. You're likely to get an increase in pay. When the economy and the stock market is not doing very well, you might lose your job, or you might not get that pay that you were expecting. Pension funds and retirement account values are tied to the stock market, even the guaranteed ones. So if you've been working 40, 50 years and you're looking at a certain amount that you will have when you retire, and you're expecting to be able to live off of that, if the stock market really hits hard times, you might have to rethink your plans or even switch your plans around. The idea is, what do I need to retire? And those of you that are retired, you want to be able to stay retired. If the stock market really runs into trouble, that might change. Also, employee benefits such as pensions may be increased or reduced because stock prices are going up and down. When a company first offers to sell ownership of that company to outside investors, money is raised, and that's known as an initial public offering or IPO. Well, once that's done, it's done. But then there's the secondary market, where people in the company own shares of that company, or the company itself may go in and buy its own shares. And this happens a lot. This helps to keep stock prices strong. When Microsoft or Apple or Google, not only are investors buying shares of that company, the companies are buying shares of that company as well. And all of that buying helps to push prices higher and keep the stock market at good levels. But when things go down, stock prices go down, now all of the prosperity that was being enjoyed before suddenly is not there, and it may flow down to you as an individual employee. And also job security. In a good economy, companies are expanding, and in a bad economy, companies are usually cutting jobs at that point. And consumer trends. Things change. Way back about 150 years ago, the main stocks to own were railroad stocks. Well, throughout the 20th century, it was really cool to own automobile stocks. Now, it's really cool to own high tech. There are some companies that are always popular no matter what we're going through economically, but things come and go. Companies such as Polaroid or Blockbuster that were once high flyers and real darlings in the stock market now don't even exist because things can change. When music first came out, the 8-track tape player was considered cutting edge. Then we went to cassette tapes and then LPs. We moved over to CDs and DVDs. But even that has been replaced by streaming. So things can change over time. Just think of GameStop, which has been in the news a lot lately. They were a real high flyer 10, 15 years ago. Now they're making news because of different stock plays that are occurring, but they're considered a dinosaur today, where 15 to 20 years ago they were cutting edge. So the economy does change over time. What was popular and beneficial during one time may be out of favor and be replaced by something else. And housing values. A lot of people have most of their wealth in the value of their home. If the economy is doing well and the stock market is doing well, typically the housing market will also do well. It was the housing crisis that caused the whole financial meltdown back in 2008. Right now, housing prices are doing very well again, and in fact, some people are getting quite concerned that we're in another real estate bubble. But as long as housing prices keep going up, people are happy. And then interest rates. We all love interest rates, especially when we receive the interest. We don't like it when we have to pay the interest. As the stock market goes up, interest rates usually go up as well. And I have other videos where I talk about this. We're in a good, healthy, non-manipulated environment, and by manipulated, I mean the Federal Reserve doing their little tricks called quantitative easing. You will see stock prices go up, and on the same chart, you will see interest rates go up as well. That's usually the sign of a good, healthy economy. We're taught very early that interest rates are bad for stocks. Not necessarily. If stock prices are going up, that means that the economy is expanding and interest rates need to go up to avoid inflation or even hyperinflation. Another area is credit cards. Even with interest rates at historic and all-time lows, you'd think the credit cards would show a little love, but that's just not true. Interest rates are still very, very high on credit cards. Well, if interest rates do go up, you can expect credit cards to also go up. They'll always be way out of line, and they're almost at usury rates already. But since a lot of people have to have credit just to be able to get by and maintain a certain lifestyle, that can sometimes back people into a corner. Interest rates do have a big impact. They can affect your mortgage or even your rent payments. If you buy a house and you have a mortgage, you'll have an interest rate that is attached to that mortgage. If you rent, the person who owns that house or property, they have a mortgage to pay. So if their payments go up, your rent is probably going to go up as well. And then different loans, whether they're student loans or home loans or personal loans. If interest rates go up, that means it costs more to be able to borrow that money, and you're going to have to pay back more. and then credit cards, as I talked about a minute ago. So a word of wisdom. This is just something to think about here. Something that you need to kind of ponder back and forth. Paying attention to the stock market will often allow you to anticipate and prepare for things before they happen. You may not really have all that much of an interest in being a big-time stock market investor, but you pay attention to it. You might go to my website or follow some kind of news source, and you keep an eye on it from time to time, and you're trying to figure out, do I want to go back to school? Am I saving enough for my kids' education? Do we want to buy a vacation home? What if we could bring one of the spouses home and they could always be at home and we could maintain things on one income? What about going on vacation or getting out of debt? These are different decisions that you may be trying to make. Well, keeping an eye on the stock market won't make the decision for you, but it's one tool that you can use so that you understand and can use as much wisdom as possible to make your decisions. And if you get really good at this, you can start to see things even before they happen. By the time any significant stock market move, especially a crash, becomes headlines, it's too late at that point. So you may not participate in the stock market directly, but you have your pension plan or your retirement plan at work, and you keep an eye on things, and you start to notice things that concern you a little bit. And so you might make some changes in your retirement fund, where other people who aren't really paying attention to things, they don't make those changes, and this could really benefit you. Now, the other side is also true. If you don't really know what you're doing and you're trying to make decisions that are going to affect the rest of your life, you really need to be able to understand the ramifications of those decisions, because they may not all be good decisions. And that's what I try to teach people in the classes that I offer. Even if you're not an active investor, watching the stock market can help you make better decisions. It's one thing to just say, oh, the market was up today or it was really down today. We need to have the context. What is the general trend of the market? Has it been going up or down? And by the time you hear about it, it's too late to make any decisions at that point. It's like trying to buy fire insurance on your house when your house is on fire. It's too late. You can't do it at that point. The thing is to try to think ahead and be a good steward with what you've been given and manage that to the best ability that you can. And you're not always going to be right, but the idea is to do the best that you are capable of doing. So thank you very much for taking the time to watch this video. I really appreciate that. Please click the like or dislike button below and leave any comments if you so desire. Consider subscribing to this channel. That would be a great benefit to help this channel grow. Please access the free workshop that I talk about at the beginning of this video. I also have a public Facebook group that I'll leave a link to in the description. And I also have a blog where I write articles that are pretty much over the same topic, but my writing style and my speaking style are quite a bit different from each other. So thank you very much, and I'll talk to you in the next video.